We're always told the economy is this delicate, intricate machine. But lately, it really feels like we've been hit with some incredible turbulence, everything from massive policy shakeups to just general global uncertainty. And yet, the headline numbers, they look good, like surprisingly good. So what's really going on here?
And honestly, that's not even an exaggeration, right? Just think about the last year. We've had sweeping tariffs announced, then canceled, then announced again. We've had threats to major trading partners, big shakeups in healthcare, the longest government shutdown in history. I mean, it's been nothing short of chaotic.
So that's the central puzzle, isn't it? And that's exactly what we're going to try and solve in this explainer. We're going to peel back the layers on these impressive numbers to figure out what's really propping up the economy and whether it's nearly as stable as it looks.
All right, let's start with the biggest, boldest number that has everyone talking: GDP growth. This is the first piece of evidence that suggests everything is just fine. A 4.3% annualized growth rate, that's a strong number, especially with everything going on. And just so we're on the same page, annualized simply means if the economy kept up this pace for a full year, that's where we'd land. So on the surface, this number is telling a story of a really robust, really resilient economy. But this single number is hiding a fascinating and massive tug-of-war happening just beneath the surface.
So what's really interesting is how we actually get to that 4.3% figure. See, it's not some smooth upward trend. Nope, it's the result of two massive opposing forces that are almost perfectly canceling each other out. In one corner, you've got this incredible AI boom. We're talking about tech companies pouring trillions of dollars into infrastructure, data centers, computer chips, you name it. That spending alone would add about 2.5% to growth. But in the other corner, you have businesses that are rapidly selling off all the extra inventory they stockpiled, and that activity actually gets subtracted from investment and growth. And the wildest part? These two forces are almost perfectly matched. So here's the crucial takeaway. All that AI spending is basically acting like a fresh coat of paint, hiding the fact that overall business investment is actually pretty weak. If that AI spending slows down for any reason, those underlying weaknesses could pop into view almost immediately.
All right, so let's move on to our next surprisingly good number, the trade balance. The data says we're exporting more and importing less, which, on paper, sounds great for GDP. But once again, the details tell a very, very different story. And this chart just lays it bare. Take a look. Of the $26 billion increase in our total exports over the last year, a whopping $18 billion, that's nearly 70%, came from just two things: gold and silver. This isn't a story about our factories cranking out more innovative products for the world to buy. Get this. The year-over-year increase in gold exports was over 500%. A huge spike.
And silver is even more mind-blowing, a 2,800% increase. So why is this happening? Well, it's largely because other countries and investors are getting nervous, and they're trying to diversify away from the US dollar. They're moving their money into safe haven assets like precious metals. This isn't a sign of a productive economy. It's really a sign of global financial anxiety.
The source material for this explainer had an analogy that just hits the nail on the head. It's brilliant. Yeah, your cash flow might look good for a minute, but this is completely unsustainable. You can only sell your valuables one time. It feels a lot more like a fire sale than a sign of real financial health.
All right, so business investment is shaky, our exports are kind of weird, but what about the bedrock of the economy, the American consumer? Consumer spending is still the biggest piece of GDP growth, and it's staying strong. Surely this has to be a good sign, right?
Well, when you actually look at where that spending growth is coming from, one category stands out way above all the others: healthcare and pharmaceuticals. So this isn't growth from people feeling confident and going out to buy new cars or take fancy vacations. No, this is growth driven by necessity.
And there are three pretty concerning reasons for this surge. First, our population is on average getting older and less healthy. Second, there are a lot of new, very expensive drugs that are boosting the numbers. And third, a lot of people are afraid of losing their health insurance, which creates this use it or lose it rush to get procedures done right now. So yes, it's economic activity, but it's not exactly a sign of a thriving, confident consumer base.
So it seems like even our strong consumer numbers are something of a mirage. And that brings us to the biggest illusion of them all, a final, massive variable that's quietly distorting all of this data, from GDP to the stock market. And that is the value of the US dollar itself. You see, over the last year, the dollar has actually fallen, by over 10% compared to most other major currencies. And this acts like a funhouse mirror for our economic data. It distorts the numbers and makes some things look a whole lot better than they actually are.
And this table shows you exactly how. The stock market is hitting record highs in US dollars, which makes people feel wealthy and keeps them spending. But if you measure that exact same market in other major currencies, it's actually been flat or even down. A weaker dollar also automatically makes our exports look cheaper to the rest of the world and makes imports more expensive, which, hey, helps explain those good trade numbers we were just looking at.
Okay, so if growth is an illusion, our exports are a fire sale, and consumer spending is being driven by necessity, why hasn't everything just collapsed? I mean, if the economy is really built on such a shaky foundation, what in the world is holding it up?
Well, the answer is that the U.S. economy isn't invincible, but it is enormous, privileged, and deeply, deeply entrenched. Its sheer size means things just don't happen quickly. The dollar's status as the world's reserve currency gives it a unique buffer that no other country has. And the global financial system is so wrapped up with the U.S. that you can't just untangle it overnight. These factors create a time lag, but they do not make the economy immune to a collapse.
So, while a sudden collapse might not be right around the corner, the real question is about the long term. All these underlying trends, the selling of assets, the anxiety over the dollar, they suggest that other countries are slowly starting to build systems that rely less on the U.S. And that gradual shift, well, that could end up being the biggest economic story of the